Hello everybody, welcome to my channel. My name is Domenico and today we'll be looking at what is options trading. So I'll be going through 5 steps with you guys to explain what this concept is, and hopefully you guys understand it better once you're done watching this video. So first we'll go through options explained, where I'll explain to you what an option actually is. Then we'll go through a call option example, following with a put option example, and then we will finish off with a few points and then a review of the topic in general to put everything together and hopefully help you guys understand this complex topic a little bit more. Let's get right into the video. Before we get into the video, guys, don't forget to leave a like and subscribe down below. It really helps with the YouTube algorithm to get my videos out there so more of you guys can see it, and so I can continue making content like this for you guys in the future. So just drop a like down below and subscribe to the channel, and let's get into the video. Thank you. Alright guys, so let's get into the explanation or definition of what an option actually is. Now, I wrote down the definition here. I put different words in different colors to put emphasis on them. So we'll break it down after I read it once. So let's get into it. So a bet, a stock, will be above or below a certain price by a given date. Okay, so let's dissect that a little bit. A bet, okay, so an option is a bet. It is not investing. Investing is purchasing stocks. Options are bets, okay? It's a lot more of a gambling game than stocks are an investing game. Will be above. If you're betting it's going to be above a certain price, then you are purchasing a call option. Or if you're betting it's going to be below a certain price, that's basically known as a put option, okay? A certain price, you have a price that you decided on. That price that you selected is known as the strike price, okay? So it has to be above or below that certain price by a given date, okay? So the date that you select is called the expiration date. Now, an option contract cannot be held past that expiration date. Once that expiration date happens, then your profits will be judged. And basically, by that date, you will know if you made or lost money based on all this information as part of the contract. Options are a lot more risky than stocks themselves, okay? So you have to always keep this in mind that this is a bet, okay? It is more of a gambling game than an investing game, okay? So just keep that in mind, and we'll get into a few examples here. And we'll start off with a call example, okay? A call options example. So let's get right in. All right, guys, so let's get into the call option example. So let's say there's a stock A on the stock market that you think will go up in the future. So it's currently at $50, and you think by January 21st, 2022, it's going to rise to above $70. You have a prediction. You really see the fundamentals with that business really coming into place, and you say this stock has to go above $70. I really believe it's going to increase in value by a significant amount. So what you want to do is you want to purchase the option with a $70 strike price, meaning you believe it's going to go to above at least $70. Now, what you're going to be paying to get this option is $2, okay? That's the premium. That's what your cost is. You're only putting up $2 of your own money to buy the actual option. You're not putting up the entire $70. You're only putting up $2. Okay, that's the cost of the option, and that varies depending on what stock you're buying and what option and what expiration date you buy. Because you don't have to go till 2022. You can go before that as well. They have long-term and short-term options. This is just a long-term example. Now, basically, your break-even price is the premium plus the strike price, okay? So in this case, you pay $2 plus you think the stock is going to go to 70, so that's your strike price. So basically, your break-even is going to be at $72. So we have 3 possibilities of what can happen with this stock by January 21st, 2022. Now, that's the expiration date. By that date, these 3 things happen. You cannot keep the option longer than that date. After that date, it expires, okay? So depending on what the stock price is at, 3 possibilities can occur. So basically, the first option is that it's below $70. Now, if by January 21st, 2022, this stock that is $50 does not reach at least $70, you lose 100% of your money that you put up, okay? So no matter what your premium was, you lose that money, okay? Now, Number two, it can either be between $70 and $72. Okay, so let's say it goes to $71. Well, basically you lose 50% of your money. So because you put $2 and it's only going to be $1 above $70, so you only get $1 back instead of $2. So you basically lose 50% of your money. And that's a ratio you're going to lose. Anything under $72, you're going to lose, but you're still going to get some money back. Under $70, you don't get anything back. You lose 100% of your money. Basically, the last option is that it's above $72. Now, this is where options get really interesting. Now, anything above $72, you're making profit, okay? But how it works is that every $2 above $72, you double your money, okay? So, since you only put $2 up front, let's say it goes to $74, you will double your money. If it goes to $76, you'll triple your money. So basically, this is how it works, and it just goes on and on. You can imagine if it goes to $80, $85, $90, $100 by 2022, yeah, you'll make a lot of money. So that's basically what options are for. It's really if you expect a stock to increase or decrease for put options, which is the next example, dramatically. Okay, so if it goes up a little bit from $50, you won't make anything. You'll actually lose your entire premium. So basically, that's a call option. So this is if you think a stock will go up in value by a significant amount within the time period that you selected. And in this case, it's a long-term option, but you can also pick shorter-term options as well. Let's get into the put option example. Alright guys, now we're going to go through the put option example. Basically here you're betting that a stock will go down by a certain date. Now, let's say you have the exact same stock, stock A, at $50 a share. Now, you think by January 21st, 2022, again, you can pick whatever date you want, but this is just for the example. You think by January 21st, 2022, it's going to go below $40. Now, that will be your strike price. So basically, you're going to be paying the exact same premium as the other one in this example, which is $2. And so basically here, you're gonna subtract the premium from the strike price. Instead, in the call option, you added them. Well, here you subtract it, okay? Because you're betting it's going to go down. So 40 minus $2 is $38. That's your break even. So basically, for you to make your money back and not lose or gain anything, the stock has to reach $38. Now, again, by January 21st, 2022, there's three possibilities. Now, it can either go above $40, and in this case, you lose 100% of your money because you're betting that it's going to go down, a put option. And if it goes above $40, then, or if it stays, at 50 or anything above $40, you lose 100% of your money. Anything between $38 and $40, which is between your break even and the strike price, you're going to lose a percentage of your money. So again, if it goes to $39, which is $1 below, since you paid $2, you're only going to lose $1. So you're losing 50% of your money, okay? So you're still losing, and anything between $38 and $40, you're going to lose a portion of your money. But you still will get some money back. You're not losing 100%. Anything below $38, that's where you make your money with put options. So anything below $38, you're making profit basically. So every $2 under $38, you double your money. Okay, so at $36, you double your money. At $34, you triple your money. At $32, you quadruple your money. And then you continue just like that, and you can make a lot of money. So basically, options is basically, again, for a very significant move in the stock price by a certain date. So the more it moves, you can imagine if this company goes to $20, this option will be very, very profitable for you. However, if it goes up, which is basically the trend of the market, you will lose a lot of money, or 100% of your money, basically. The risk with put options is basically, on average, the stock market increases in value over time, okay? So over time, if you pick a basket of stocks, 99% of the time, during that period of time, it will increase in value. Now, the put option, you're betting that it's going to go down in price. So this is a little, this is mostly for companies you really see having a difficult time in the future. You see their balance sheet is very, very poor. You see they are losing money. You don't think it's sustainable. This is when you use put options. But in general, put options are a lot more risky than call options because in general, the market does increase in value over time. So that's the put option. Now let's get into a review of options in general and when to use them and when not to use them and all these. Alright guys, just a few points before we get into the review of options in general. Number one contract equals 100 shares. So I didn't explain this in the previous examples because I didn't want to confuse you guys. But if you do understand the previous examples, basically every options contract you buy represents 100 shares. So basically what you have to do is multiply the premium by 100. That's the minimum bet. So let's say the premium for the examples was $2. You're going to have to multiply that by 100, and that's for one contract. Okay, you can't buy less than one contract. So basically if the premium is $2, 2 times 100 is $200. So your minimum bet is going to be $200. You cannot buy less than one contract. Okay. So that's for any option. Basically, every contract represents 100 shares. So always multiply the premium by 100, and that's the price of one contract. Okay, that you cannot bet less than that. And number two, do not give up. This is a very difficult concept to understand. One of the most complex in the stock market. So if you do not understand the examples I did previously, go back and watch them, and then come back to this, and then try to understand this, because this is just going to confuse you more if you didn't understand the previous examples. So do not give up. Keep rewatching until you finally understand. Most people do not get it on the first time. Okay, so go through the examples, try to think of it yourself, and just do not give up. Look at other videos, try to research this further, because this is not an easy concept to understand. This is one of the most difficult concepts in the stock market to master. Okay, so if you do not understand, just don't give up. Okay, guys, let's get into the review. Alright guys, so let's review what we learned in today's video. Now firstly, options or stocks. When you're picking whether to purchase options or stocks, you have to think of basically a few things. Now, options are riskier than stocks in general, okay? Options you're betting, stocks you're investing. Options are more of a gamble, stocks are more of an investment, okay? Options, you have a time limit to how much time you can keep the option for. Stocks, you can keep them as long as you want if you're going long options. Stocks, sorry. Options, you have to, there's a minimum bet. So basically we're going to get to that later. Stocks, the minimum bet is the actual stock itself, the stock price itself. And basically options are, so options are a lot more risky. Stocks are a lot less risky in general. Also, options are better if you believe a stock will either go up or down in value, depending on what option you buy, very significantly, okay? So, basically, options are very, very good if you believe a stock will double, triple, quadruple in value over a period of time. And in that case, you can make a lot of money with options. And stocks are just basically if you believe they're going to increase in value over time. Not by significant degree necessarily, but options are basically you betting that it's going to increase in value by a significant degree by a certain date. Next, call options are basically you're betting that a stock will go up over time by a certain date. And put option is basically you're betting that the stock is going to go down. And lastly, every contract represents 100 shares. So what you have to do is multiply the premium by 100, and that is the minimum bet for buying one contract, okay? And every contract after that, you just multiply that by the number of contracts you're purchasing. So that's the review. Guys, if you enjoyed the video, don't forget to leave a like and subscribe to the channel. Again, it really helps with the YouTube algorithm, get my videos out there so you guys can see more of this content in the future. But apart from that, guys, thank you for watching. Have a great day.